Another volatile session is underway for the U.S. markets as stocks look to be on track to cut January as a loss. Joining me now is Bob Phillips, the managing principal at Spectrum Management Group in Indianapolis. Hi, Bob.
Hi, Sue.
So investors are feeling uncertain with the disappointing GDP report showing the economy grew much slower than expected last quarter. Lower oil prices and stronger dollar are historically positives for the economy, but how come both those trends didn't come into play?
Well, I think it takes a while, Sue, before declines in oil are really reflected in positive numbers in the economy. I suspect that last quarter, and I have not seen the details yet, but probably capital investment may have been down. That may have been part of the reason. Employment's actually quite strong in the U.S., but typically, historically, when you have oil drop, we've had 6 of those occasions where it's dropped more than 35% in 6 months. The initial reaction always is the market gets much more volatile. The economy sends off some uncertain numbers, but it takes 3 or 4 months past the bottoming of oil prices before you see positive things flow back into other parts of the market and other companies.
And for the most part, though, Wall Street has kept its focus on earnings, and this week has been a busy one. The season started off on a not such good footing, and now we're getting a mixed bag of reports. But why do you think earnings will be an overall positive note?
Well, it goes back to looking at some of those historical times when you've had these tremendous drops in oil in particular. Again, there's been, I think, 6 times since 1986 where you've seen oil drop by 35% or more in 6 months. And what initially happens is analysts go back and they start readjusting their estimates. So obviously energy companies all get moved down in terms of expected earnings growth. So if you look back to September of 14, looking forward for 12 months, analysts were expecting the market to do 15% better in earnings over through September of 15 versus 14. You look at that as of December, we're down to 10%. You look at that as of last week, it's down to now 3%. So there's this ongoing adjustment of expectations, which gets reflected back in expectations of earnings decline, which certainly they're going to do in the energy sector. So I think we're right in the midst of that. Now, if we go out 3 or 4 months from now, I think what we'll see the impact of the lower oil prices coming back through sales of other corporations outside the energy sector. And then we'll start seeing expectations of earnings go up compared to some already reduced expectations. It'll be a positive momentum from that perspective.
Bob, let's just talk quickly now about some stocks that you like regarding the European play. You like Priceline and Delta. Tell us why.
Yeah, I like Priceline. We like Priceline because of the European play. We think that the weakening of the euro has been reflected in Priceline stock. And we think Priceline's got tremendous growth. So in a world where you've got struggling economies, but you got a company that probably can grow its top line by 15% or so for the next 3 to 5 years, that's going to be very attractive. Priceline has I think a very, very strong network effect. And unlike the U.S., European and Asian hotels are very much boutique oriented. They count on Priceline for customer discovery and customer flow. So we think that it's been beaten down because of the euro. It's got some very good growth ahead of it and should do well. Delta it's got 2 tailwinds behind it. It's got low oil, which cuts their cost, and consumer confidence actually is quite good. And in the past, when consumer confidence has been strong, airlines have done quite well because airline travel's picked up.
Great. Thanks so much for speaking to me today, Bob.
Thank you, Sue.
Bob Phillips is the managing principal at Spectrum Management Group, and I'm Susanna Lee for The Street.